You're listening to the Financial Source podcast on YouTube.
Welcome to our latest deep dive. Today we are opening up a recently leaked market intelligence report.
A really dense one, too.
Yeah, it is. We need to understand exactly how global financial markets are reacting to the escalating military strikes involving Iran, the U.S., Israel, and the U.K. Okay, let's unpack this.
And before we get into the market internals, let's establish our parameters for this analysis.
Good idea.
We are strictly examining financial data, capital flows, and market sentiment. We aren't taking any political sides regarding the conflict itself.
Right, just the data.
Exactly. Our mandate is just the financial fallout. And the dominant theme we are tracking today is an incredibly fragile risk sentiment driving a massive flight to safe haven assets.
You can really see that fragility playing out in the currency markets right now. I mean, the U.S. dollar index ticked up about 0.2% as institutional money just rushed towards safety.
Yeah.
But at the same time, the euro took a pretty significant hit, dropping below the 1.1800 mark. So how much of that euro drop is tied directly to the geopolitical strikes versus the noise surrounding German Chancellor Friedrich Merz right now?
It is a compounding effect. The geopolitical stress is the baseline, but the euro's drop was heavily exacerbated by Chancellor Merz openly expressing severe economic concerns.
Ahead of his Washington meeting.
Right, his meeting with U.S. President Donald Trump. When you have tariffs expected to be front and center at a bilateral meeting like that, currency markets get incredibly defensive.
And it isn't just the Eurozone feeling the heat. I saw the British pound dip directly following reports that Iran had targeted a UK military base in Cyprus.
GBP to USD fell 0.2% almost instantly. What's fascinating here is the sheer speed of the reaction.
It's basically instantaneous.
It isn't just that the pound dropped, it's that algorithmic trading models process those Cyprus headlines in milliseconds.
Yeah.
They just immediately dump risk and pivot.
We saw a similarly complex reaction with the US dollar to Japanese yen pair.
Yeah, that chopped around a bit, but ended up 0.1%.
Because both the dollar and the yen were absorbing heavy safe haven flows simultaneously.
Exactly. Plus, BOJ Deputy Governor Shinichi Himina stepped in to reiterate that interest rates will continue to rise as long as price stability is maintained.
Which just added to the volatility.
Absolutely.
Now here's where it gets really interesting. The commodities roller coaster.
That was wild to watch.
The price action gave me absolute whiplash today. Brent crude initially spiked over 4.1% and WTI jumped 3.6%.
Clearly on fears that the Strait of Hormuz might get shut down.
But then the rally completely evaporated. Brent collapsed back under $80 a barrel and WTI fell under 70. What exactly pulled the rug out from under that surge?
It was a textbook collision between geopolitical panic buying and a hard supply-side reality check.
The OPEC news.
Right. Right at the peak of that Strait of Hormuz panic, reports leaked that OPEC Plus is officially planning to add 206,000 barrels per day to global supply.
Starting in April.
Yes. So the trading algos instantly pivoted from pricing in a geopolitical supply shock to pricing in a tangible supply surplus.
And while oil was wiping out its own gains, the traditional safe havens were locked in. Gold rallied almost a full %.
Stalling out just underneath a staggering $5,400 an ounce.
Meanwhile, copper slipped about 0.4%.
That divergence tells you everything you need to know about current risk appetite. In this environment, investors are completely ignoring industrial fundamentals.
They don't care about underlying economic growth metrics.
Not at all. They just want the hard security of gold.
So what does this all mean? For you listening, tracking these fractional moves and macro trends, why is this specific flight to safety so critical to watch?
If we connect this to the bigger picture, this kind of aggressive flight to safety combined with extreme vulnerability and energy choke points threatens to reignite supply-side inflation.
Which is the last thing anyone wants.
Right. And if that happens, it puts central banks in a massive bind.
Yeah.
They will be forced to maintain restrictive monetary policy far longer than markets have currently priced in.
Meaning everyday borrowing costs stay higher for longer.
Precisely. Which could completely upend current yield curve expectations and heavily impact global liquidity.
It really is a massive economic domino effect. And it leaves us with a final question for you to ponder.
A big one.
As we watch these violent algorithmic price swings tied to vulnerable geographic choke points like the Strait of Hormuz, could these repeated geopolitical shocks eventually force a permanent, irreversible rewiring of global commodity supply chains?
Something to definitely think about.
Keep an eye on the markets this week, everyone.